Let me welcome our panelists. We have Rajesh Krishnamurthy, Country Head India for Financial Planning Standards Board Limited. Hi, Rajesh. We
Hi,
have
thank you.
Ashwin Patni, Head of Product and Alternatives from Axis Mutual Fund. We have Manish R, um, Head of Product Communications from ICICI Prudential AMC. And we have Ong Ziang again, Senior Macroeconomic Analyst from IFAS Financial Singapore. Good afternoon to all of you, gentlemen. Over to you, Rajesh.
Thank you, Deepali. It's always a great pleasure to be with friends whom you know in the industry and also with friends you will make in the industry, right? Thank you. Manish, hi. Ziang, good to see you. Hi, Ashwin. Uh, we have a very interesting thought, uh, and that's a thought that's going around in everybody's mind, which is about whether India is a place to invest, whether emerging markets is a place to invest. Would emerging markets do better than the world? Why? So many questions. And I guess what better than just handing over the mic to each of you and just getting you to go with the flow and answer those questions, right? So let me just try and start with the alphabetical order. Ashwin and Jiang, I'll come last to you. Uh, Ashwin, so I mean, to make it very quick, if you were to just give one important pointer as to why emerging markets will do better, what would be that one thing?
So thanks for that. Let me kick off by saying that frankly, in a long-term perspective, what we would the way we would like to see it is that uh, investing in EM is not about looking for whether it will outperform or underperform India. The idea is to actually find broadening of opportunities. Can we look at countries which can give you access to opportunities which you don't get in India? And that is where really global investing and of course within that EM investing should be seen. To respond to your question, what is that theme? I think briefly was covered in the previous session also, but I think clearly the most exciting opportunity within EM is of course the entire Great China region. And clearly, that is something that would be investors should look at very carefully to be able to take more view on EM, because China really dominates the entire EM space, and it has a lot of interesting listed companies. There are a lot of interesting themes there, and that is one thing for investors to keep an eye out.
Ashwin, Manish, what's that one thing, Manish?
Uh, Actually, I think it's not one point. I think there are so many points which are creating a conducive environment at this point of time. Why we should consider emerging markets at this point of time, and probably I think I'll take 2 or 3 minutes and just jot it down those pointers. And I think the previous speaker has also beautifully picked it up that what are the elements which are creating a conducive. I think first thing which we need to look at is the kind of global liquidity conditions which has been created by the central banks is massive. And if I say that, if you put together the major central banks, when we are talking about European Central Bank, ECB, or we are talking about the Fed, or we are talking about the Bank of Japan, last year, that is calendar year 2020, they have pumped in a liquidity almost close to 8 trillion. And I'm saying that's massive when you're looking at in that context. So point number one, the global liquidity. Point number two, if you look at the stimulus measures which has been provided by again the G7 countries is massive again, and there is negotiation going on whether we should go, whether US should continue with the 1.9 trillion fiscal stimulus measure or not. So this point number two is fiscal measures which has been provided. Uh, if we move ahead, if you look at the vaccine development which has started, especially in November, when we have seen Moderna and Pfizer came up with an efficacy of 95%, that is something again very positive for the growth. That is very positive for how the reopening of the economies can happen. And one more element, I think it's slightly dated, but it's important to be highlighted here. You remember the election which has happened, US Fed election, and which Biden coming into picture. That is also something which is very positive for fiscal stimulus or measures. I think these 4 5 points, if you put together, is something which is creating a very solid, conducive background or an environment for the emerging market to perform. So, with that, I'll hand it back to you.
Thanks, Manish. Jiang, over to you. What's the news from Singapore then?
Okay, we actually more favorable on emerging market as a whole versus in India. I think for the points for emerging market, you guys probably have heard from my presentation. So before I'd like to zone in a bit more why we favor. Firstly, I think EM being a whole diverse region provides a little bit more diversification in a way. As compared to India having its own idiosyncratic risk. I think India itself, valuations are really high. It has the performance has been pretty great and I think I do like India for a lot of its cyclical exposure towards your financials, your industrials. But one of the key things for India is that it oil is actually quite a main source of imports. So with prices at oil prices starting to pick back up, you'll start to eat in a bit in terms of the margin for your oil refiners. And that will sort of weigh down in terms of input costs, in the rising input costs in terms of the entire profit margin of your India equities. And as your earnings, even though as your revenues start to pick back up, your earnings may not see the kind of robust rebound that you would like to expect of emerging market within a global reflationary environment. And I think ultimately it has to do with the frothy valuation right now. So probably set up to so investors who are investing into a bit too much or overweight into Asia, into your India equities are quite vulnerable to a near-term correction, which could be healthy for the long run, but as an investors, you would not be that happy to kind of sustain the kind of correction in terms of your portfolio.
That's interesting, Jiang. Thanks for that. So, Manish, let me come back to you. There's always this. So I'm more trying to make it very simplistic in the question, but I'm sure you have all deep answers. Pretty much everybody talks about a country's growth, and GDP being the key indicator there. Whether it's real or nominal, there is always an eye on GDP. So, do you really see that there is any kind of relation or no relation between the expectation or the actual GDP growth that one is seeing and the kind of run-ups that we are seeing or the sell-offs that we are seeing in different markets? I mean, especially in the context of emerging. Is there some perspective you wanted to throw there?
Yeah, I think that's a very interesting question, and I think this has something which has we've been asked many times in the last, I think, 6 7 months, especially post the COVID correction, and after that you have seen the market going just one level up, and people were asking questions. Oh, your GDP is still down by 9.5%. How come you're seeing your market still growing like that? And I think the answer over here is that when you look at GDP, when we talk about GDP per se, we are looking at the complete picture. We are also looking at SMEs, MSMEs, which are not listed, or we are talking about GDP. We are also talking about services like a housemaid. We are talking about services like a person who's doing a gardening, etc. So GDP includes all those services, includes all those SMEs, MSMEs, which are not listed on the companies. So when I talk about these segments which I've highlighted, the SMEs, MSMEs, or the, let's say, a gardener or housemaids, these daily laborers or wagers, those are the part of the economy is something which is hit very, very badly because of COVID. And that has clearly got percolated into the GDP numbers or GDP figures. But when we look at the equity markets, this is something which we are talking about companies, people who are there in the white collar job, people or companies which are listed. We are talking about the large caps, mid caps, small caps companies which are well established. For them, the COVID impact was not so brutal as compared to what has happened to other side. So that's why you see the equity market, which is a representative of a very certain strata of the economy, has done very well because they have been able to do well because of all the disruptions and all that. They were market gainers, and that's why the market has performed beautifully. But in the meantime, GDP, when you look at it, which gives a consolidated view of the overall economy, including all the strata of economy, that has been something which is corrected. So I think that should give that divergence.
Interesting points, Manish. I mean, I am also just trying to make my notes here as you're speaking. Interesting points. Uh, how about you, Jiang? Is there something that you wanted to add in on this whole dialogue between tracking the GDP and tracking the market valuations?
I think Manish put it beautifully in the as his points are quite clear. In fact, that's not just in the Indian market, for the rest of the world as well. So, say for example, in Singapore, the market growth is the benchmark index is not a very close representative of the economic growth. The economic growth is going to rebound, but there's a certain components such as for example Singapore, like your SIA, your airlines that are not going to recover anytime soon at this point of time. And in fact, even so, you go all the way to say your US, you can see that a huge component of its in the S&P 500 are your international companies that are more affected by your international revenue than its domestic revenue. So to say that, well, I think for a long time, we like to use the index as a simplistic representation of the economy. It's not exactly a one-to-one kind of apple and apple comparison. But I think interestingly, so for a lot of your EM markets, the makeup of I would say that for a lot of your EM, like your Latin America, your Asia ex Japan economy, their index are still a bit more closely related to this economy. So in this global reflationary trade environment, you're gonna see that kind of expression in terms of a rebound being expressed a lot more closely within your EM equities. And as a result, that is also the reason why we are more favorable on the emerging market equities versus the rest of the world. And I think back to India more specifically, is that your Sensex, your Nifty 50 are just 30 to 50 of your biggest companies. So these companies they have the financial condition, your balance sheet to tide through your COVID pains. But your SMEs are the ones who are beaten very badly. So you can have your SME being beaten down, but it's not expressed in the equity market. While your larger large cap companies who have the balance sheet, they are actually taking the opportunity to take off the market shares from your SME that are dying out from the industry. So so we are seeing sort of a disparity in that case, and it's being amplified by the nature that the index is not a close comparison to the economy. Yep.
Thanks, Jiang. I mean, I'm always reminded, and when I have chats with Ashwin, he always keeps talking about why we should not be just fixated to the GDP growth, but look at more opportunities. Ashwin, you want to throw some more light on those thoughts, Ashwin?
Yes, fantastic point, because even if you take very long-term trends, and obviously the speakers have highlighted what's happened in the near term with the COVID impact, but even when you look at very, very long-term in the market structure, a simple example that I can highlight is, again, to take the example of China. It was the fastest growing economy in the world in the 90s. But it had a very, very peculiar market structure where certain type of companies were listed, which were not very capital efficient and which were not terribly sort of good at generating shareholder returns. And as a result, it was, while it was, one of the best performing economies in that era, it had one of the most disappointing stock markets in that era as well. Whereas if you see today, the scenario has changed and we've had a dramatic change in their stock market. So different times, periods in time, different types of companies that are listed, the kind of companies that are, form the part of this market, I think that can really determine what happens. And that's where GDP is a very simplistic number. And I think investors should avoid that. I think the important thing that investors should look at is where the opportunities are from a listed market perspective and the kind of companies that are generating that new wave of growth which they can participate. Because equity investing, ultimately, it's all about structural growth and which are the companies and themes that can give you that.
Interesting. So then maybe as it has to be, Jiang has to take this question then. Jiang, uh, Jiang, when you look at, uh, leave aside the political aspects of China and India because that's beyond our control and that's not a
Yes,
topic for our discussion either.
yes.
Purely from an investment point of view, and I would like you to be extremely open about, how an investment manager looks at the opportunity, leaving aside, the political aspects. But where do you think, this whole comparison between within emerging markets, the China and India story seems to be, from your perspective?
From my perspective, in terms of economic growth, they actually share the same kind of benefit. I think, in fact, in terms of economic growth, India could be at a better shape. Your demographics a lot younger than that of China, and that means that for your longer term kind of growth, India will start to pick up, and will be will probably. But for China, on the other hand, for your very longer term economic growth concern is that their demographics is actually moving more towards an aging population, and they eventually bite them in terms of your economic growth. But I think set aside the longer term kind of out view, you look at it in the near term, there's a lot more tech representation, a lot of your consumer, your internet innovation being expressed within its equity market. So your big three kind of Baidu, Alibaba, Tencent are making leaps and bounds in terms of a lot of the consumer internet kind of innovation, and they have become so big that any startup in terms of in the China environment has to have to go to them in order to sort of launch their business. And as a result, a lot of growth is actually being captured within these few players. And I think over the long that, and also I think in terms of its consumer, it's getting a lot more affluent, and they are a lot more comfortable with spending things online. It's very very similar to India, but just the index or the equity market made up is just complete. It's a little bit different. For India, it's still a bit more economically cyclically sensitive, while China is moving more towards that new digital economy that the rest of the world is heading towards. So I'll be thrilled if the India equity market start to list a lot more of your tech giants, given that the fact that India itself is, sort of a bit of a tech capital of the world as well. So but so at this point of time, I'm favorable on both these two markets. India is something that we're looking at for a while. But right now, in terms of valuation, in terms of valuation, China is a little bit more interesting. While at this point of time, India equity market is a little bit frothy, as per se. So that would be my take on these two. But these two markets are definitely on my watch list. And set aside the kind of political, that's for the politician. That's not our job. We look at it in a more pragmatic point of view. We will favor China at this point of time within the emerging market space.
I see. So, that calls in for some interesting conversation with Manish then, because Manish, I know you are you are also very bullish on the prospects that India has to offer. So, within the emerging markets, why India is a question then that beckets. Uh, we did hear Ziang talking about it, but is there enough? So he says India is a bit frothy at this point in time. Uh, uh, would it be bubbly? Is that going to be enticing? What do you think?
Yeah, Rajesh, thank you. I think, you're correct. I would be having a little difference of opinion over here. And I feel India is in a very good shape at this point of time. Really happy India is going through its business, and probably I can enumerate all the points one by one. But I think what first thing which I wanted to highlight, because there's been some talk on valuations, and I feel that yes, when you look at 1 year forward, PE for India would be 23, 24, which is probably 2.5 standard deviation more than what we have seen long term average. Having said that, if you compare it with the emerging market basket completely, if you put together, India is currently trading at a 35% premium to the whole emerging market. Normally, on a long term average, India trades at a premium of 40%. So, in fact, at this point of time, we are only at 35% premium, not at 40% premium, which is long term average. So, if you compare it with an emerging market, we are not expensive. That is point number one. Second, which I would like to highlight at this point of time, is that I won't be so bullish on China at this juncture as compared to India when you're putting India together, because when you look at China, China was the first one to get affected due to COVID-19 and the first one to come out also. So they have kind of in a recovery phase which is slightly later as compared to India. Because if in India, if you see that the recovery has just started, we are in the nascent stage of recovery. Uh, and in India, if you look at, we had a severe lockdown, which has a massive hit for our growth, massive hit for the supply side disruption which was created. Second, the kind of cases which we have seen in India, if you remember in September, October, was massive. Yani we were every day clocking such a high number, and we were almost about like it was just not looking like an end. So what happened is that the whole 2020, if you look at, because of these two reasons, a severe lockdown and the kind of cases which we had, India has actually underperformed the emerging market in the last 1 year. So in terms of valuations, in terms of performance, if you look at, India is still, I feel, in an initial recovery phase, and that's why I think in the coming next 1 2 years, India can perform very well. And just to extend, probably I'll take 1 more minute just to explain on the India side also. If you look at the environment which is getting created in India, which I've highlighted at this point of time, if you look at, we have a very solid monetary stimulus which is being provided at this point of time. We have almost 6 to 7 lakh crore of liquidity which is just sloshing around in the system at this point of time, and interest rates are pretty low. We are not looking at an interest rate hike kind of thing. The budget, which has provided a massive fiscal stimulus. If you go deeper into the budget, this time the fiscal deficit is 9.5. Next year, we are looking at a 6.8 fiscal deficit. And by FY26, that is 4 years ahead of it, we are still coming down to only 4.5. The earlier trajectory was 3.5. So government is very cognizant that at this point of time, we have to give fiscal stimulus, otherwise the system won't be able to survive. And I think that's in place. And this stimulus measures, I think that should be a very great conducive environment for the next coming year for India. Thank you.
Thanks, Manish. I did note earlier that you did mention about the liquidity aspect as well, and connected to it was your comment on the vaccine deployment, and which is like looking up in different areas in India. But while we wait for Ashwin, I guess we just lost him for some technical issue. But I just had one more quick question. This liquidity perspective, and both of you can please try and chip in with quick answers because you'll just be running into designated time. Do you think the availability of fairly low cost money, and typically what the world calls it carry trade, is that really triggering a lot of emerging market upside, in terms of the performance? Because I mean, from an investor point of view, is that triggering? Because that along with the fact that from a domestic investor's point of view, if I were to expose myself to international investments today, would my currency eat into my possible returns? I mean, any quick perspectives, and we have Ashwin back as well. Ashwin, if you heard my question, two things here. Is there some
sorry, I just had some tech
problem? Some carry trade effect that's flowing in liquidity into emerging markets. That's one part of it, and the other part is, if you are an investor within such emerging markets, would looking outside of that market makes sense if in case the currency, kind of ends up eating into your returns that you might generate elsewhere. And kind of connected, maybe disconnected, just throwing it out in the open.
So, do you want me to go first?
Yeah, please, please.
Okay. So basically, I think see, currency is very important because it determines sentiment and flows. It's important because people look at it to decide near-term sentiment, etc. However, currency is not a big a driver of the actual long-term equity performance from any market. So this is how we should look at these two things slightly differently. Look at currency more to see how the sentiment and near-term flows and near-term performance can be. But ultimately, when you're allocating to a market, don't allocate because of the currency part. Allocate because of the opportunities in that market, etc. And in that sense, I think they again because some of them have really become strong currency. Also, I think it's ultimately when you look at the attribution of equity returns, it is much more driven by underlying performance than currency. The other thing I'll also highlight is typically fund managers do adjust for currencies when they are making these kind of investments. So they are also able to manage some of these effects a little bit better. So ultimately, like I said, for investors, currency may help in terms of managing, navigating sentiment in the near term. But the long-term structural case has to be seen other than currency. It has to be seen more in terms of the pure growth prospects itself.
Any perspectives, either Manish, Ziang, any one of you? Because then we will have time to take at least a question from the audience.
Yeah, I think I'll just put a minute or so on this. And this is a very interesting question again. When you say that there is so much of liquidity, is that because you're seeing the valuations going just next level? Because effectively, the yields, whether you're talking about the debt yields, are available at 0%. So there is no logic people put it in a asset like debt, and that all money is moving into an equity asset class, and that's why the valuations is looking. That's a very solid point which we have. But I just wanted to like put this in slightly in a bigger picture. If you look at post 2008, after 2000, the GFC crisis, we've been living in a condition where the interest rates are coming down. We are living in a condition where the liquidity conditions has been very, very ample. Just barring probably 2013, where we have seen a taper tantrum where Ben Bernanke came out and made a statement. Apart from that, we have been living in an environment where the interest rates are coming down, liquidity conditions is improving. So I think environment was there for equity market to continue performing and do well. But at this juncture, the major difference, which is actually giving us a more confidence that the emerging market and all can come back well, and the winners can be different this time. Why I'm saying the winners can be different, you have seen the tech companies doing extremely well for the last 10 years. So if you look at S&P 500, the big tech companies contribute almost 25% of the index, which is all-time high if you compare it with the 2000 dot-com bubble.
Yes,
But
true.
this time, I think the winners are going to be different because there is a stimulus measures which is going to come in. So liquidity is one condition which has created an environment, but going forward, I think the fiscal stimulus measures, the value stocks, which where the earnings can come back and all, I feel that is something which is going to the earnings story is what going to play out well. So it would be more about expansion, PE expansion and all, rather than what we are seeing. So,
Thanks,
thank you.
Manish.
Right.
Ziang, anything from you?
Okay, I think Ashwin and Manish actually talk about a lot of very good points. So there's really not much for me to add. But just one last thing, say for example, for in terms of investing for the I think for the rest of a lot of your global investors, they are looking at their portfolio in a more professional, more diversified way. It's all about relativity, right? So a lot of your carry trade are definitely going to benefit for your EM markets, your India, your Latin America, your China markets are going to benefit from the carry trade simply because in the developed world, if you look at US and Europe, yes, longer term yields are starting to pick back up because of fears or more of like inflation. inflation expectations starting to pick up. But I think if you have listened to the kind of conversation or the speech that Powell has been talking about, is that inflation is not going to pick back up that substantially. In fact, we are looking at a global reflationary environment, and that inflation not picking up to sort of the Fed's yet has been there for the past. It's not just a 1 or 2 year thing. It has been around for the last 10 since the Great Financial Crisis, 2008. So your interest rates are not going to come. It's not going to pick back up very substantially within your developed market, which also means that when the world start to recover, a lot of your developed world market investors, these wealthier investors, are going to look into into your emerging market to look for growth opportunity, and that is where your domestic markets, if you are a be it you are India investor, you are ASEAN investor, you are China investor, you are South Korean investor, you're going to benefit from that kind of inwards flow from your foreign capital. Yeah,
Yes,
and I think
yes, that's great. So we have, I guess, a question from the audience. Could we have that on screen, please? Yeah. Okay, Zian, that's for you.
he actually in terms of heading into the start of this year, I think we are quite optimistic on India as an economy. We think that the valuations are a little bit frothy at this point of time, as well as there's a lot of idiosyncratic factor that is weighing down on India as a market. So we didn't actually express a very positive or a very optimistic view in relation to the rest of the world. But looking ahead, I think Manish actually talked about it just now, is that a lot of monetary policy help, fiscal stimulus is being pushed out to support your huge consumer market within India. And as soon as we start to see a lot of these early signs of reflation, a lot of your recovery in terms of economic growth in India starting to pick back up, we definitely have it on our watch list, and we will look to upgrade it whenever we think that the signs are clear that India is going to be a very good risk reward kind of prospect. So at this point of time, we opt to stay a sort of a very or more neutral stage, or maybe a little bit underweight. But yeah, things are going to change as market conditions change.
Interesting. We probably can take one more question and then we will just have to wrap up. That will be the time that we have. I guess the one that is on my screen actually says, do we know funds that invest in markets like South Korea and China and US? Oh yeah, yeah. Are there any asset managers who invest in South Korean markets? And I mean, have we seen country-specific South Korean funds, Zian? Do we have something like that?
Okay, so I'm not sure whether I can take this question because it's going to be a little bit more specific to the Indian market itself. And I'm not that familiar with the fund selection that is on your platform. But I think across the world, even in Singapore, there's not a lot of markets that provide such specific geographical exposure. So but the thing is that South Korea, your China, your India are major components within your Asia, Japan kind of equity funds, which I believe on India platform should be there's definitely be on the platform. So if you want to express a more optimistic stance on these markets, go ahead and go with a more bigger approach in terms of your Asia ex Japan fund picks. But if you want to express more, say, a more specific or more overweight position on South Korea, you can look at the big names. Your your Samsung Electronics, your SK Hynix, a lot of your semicon or even your automotive makers. You can actually just purchase it either via uh, maybe via equity, single equity exposure through your US market, or yeah, to kind of add on to exposure to in terms of the whole entire portfolio. Yeah, but it depends on your platform. I would suggest the best bet right now probably would be Asia ex Japan.
Ashwin, you wanted to chip in something in between, so please.
Yeah, yeah. I just add here that the Korean market, has obviously a few really good stocks, but the issue with any country market is whether you do a single country product is you have to see whether you can make a well-rounded portfolio from that country. It has to be a big enough market. It has to offer a breadth of opportunities. And we are obviously a little spoiled here because the Indian market is so large and it is such a large breadth of opportunities. So when you're looking at markets outside India, there's just a handful of markets, probably only US and China, if I could name two, who are big enough in broad enough in terms of offering a breadth of opportunities. Otherwise, for instance, as Z already mentioned, it's much better off being into the broader strategies, whether it's the Asian, EM, or global strategies, because those fund managers are able to pick and choose the best ideas from each of these markets and play them out. Therefore, I feel that I mean, yes, there could be a few funds for every country in the world. I mean, people have a lot of funds out there, but from an investor's perspective, especially investors in India, I think broader is the way to go. Just we are very early in our global investing cycle. Don't try and find too many niche ideas at this stage. Just stay with the broader allocation products at this stage.
Thanks, Ashwin. I mean, been a quick fire for all of us. It's a Friday evening. I'm sure probably we are between a lot of participants and Friday fun. So, without further ado, let me just take the opportunity to just thank Jiang, Manish, Ashwin. Very kind of you. I just went the reverse order. And I'll hand it over to Dipali. Dipali, over to you.
Thank you, Rajesh, and thank you all of you panelists for a very spirited conversation. I'm sure our audience enjoyed that a lot. Thank you so much for your time.